All right, we've made it to the third and final part of the lecture. It only took nearly a whole week to get through it. So this is the acquisition of assets, corporate assets, both by a corporation and being sold by a corporation. And this is a pretty common transaction. And what we're going to see is there's a number of different ways to handle it. And we really need to understand this in order to tee ourselves up for reorgs, which are in theory coming next. So let's just get going. Okay. So first we need to understand the difference between these two acquisition transactions. So you can come in and buy the assets of a corporation. That's an asset acquisition. And so what happens is you literally are buying the assets. So I'm buying the machine and the land and the factory and the buildings and whatever it is. And I'm buying each of those separately as different assets. And so what happens is these are a taxable transaction, right? The selling corporation obviously is going to recognize tax on any gains. And the buyer gets a step up in basis to the market value, right? Because what happens is they pay, regardless of what the previous owner's basis is in the building, they're paying market value for it. And as a result, they're going to take market value as their new basis. Stock transaction is, instead of going in and picking out the assets individually and buying them, you just buy the stock of the entire corporation. And so by default, you get ownership of all the underlying assets. Now, this is also generally taxable, but it's taxable in a different way because now the seller is selling stock to the buyer and will recognize capital gain. So, and again, we're largely talking about this from the perspective of corporate ownership. So a corporation has a basis in the stock of, its subsidiary, and it sells the entire subsidiary to a new corporation. Well, it recognizes gain on the sale of the stock. The corporate entity itself stays intact, right? There's no change. It's just got new owners. And the bases and other tax attributes of whatever was inside that corporation, they just carry over to the new owners. So there's no real difference. Now, assets are considered cleaner from a legal perspective because there's no hidden liabilities. When you buy the stock, you, of course, buy all the assets and liabilities of the corporation. Well, that tends to be all the known liabilities of the corporation. So if they, bury dead bodies in the water table and they could get in trouble, you just purchase that because you purchased the corporation. Now, you can try to put some indemnification clauses in this sort of thing, but those haven't always worked out. This requires retitling the assets to a new owner. So that means, obviously the building used to be held by X, now it's held by P. And so as a result, you have to go through the deed process and get everything recorded, et cetera, et cetera. In an asset acquisition, the liabilities can just be left behind with the previous owner. You don't have to acquire any liabilities. And you can also cherry pick the assets you want. You may not want all of the assets of the corporation. You may just want part of them. So obviously a stock acquisition can come with hidden liabilities, but there's generally no retitling because remember the corporation remains in place, so there's no retitling, and it's generally considered legally easier just to buy the stock. Now you may get some unwanted assets because you don't get to cherry pick them, and you may have to deal with minority shareholders to the extent those exist. Okay, so a basic sale of corporate assets is what we're used to. You've heard me repeat this 1,000 times. Erica, you've probably been in my class too many times to count. Amount realized less adjusted basis is the realized gain or loss. And of course, without any particular provisions that say otherwise, that realized loss would be the recognized gain or loss. Those gains or losses are added or subtracted from the E&P of the corporation because remember, it's still around. Any capital losses are limited to capital gains with a 3-year carryback, a 5-year carry forward. So when purchasing multiple assets, each asset is sold separately. So you allocate the amount realized based on the fair market value of each of the assets sold. And so you take the market value less the basis in order to calculate the gain or loss. So X Corp purchases a commercial lot in 05 for $30,000, builds a warehouse on the site in 06 for $60,000, Depreciation on the warehouse, 32,000 was taken. And through the date of the sale in which the property and warehouse are then sold for 110. Well, this is not unlike any other sale of business property, right? So allocate the sales price to the land and the building based on the fair market value at the time of sale. If the fair market value of the land is 40,000, fair market value of the warehouse is 70,000. Then you take the 40,000 of the land minus the 30,000 of the basis in the lot, you get a $10,000 gain. You take the 70,000 value of the warehouse, deduct out the 60 minus the 32, right? Because we depreciated the warehouse, you get a $42,000 gain on the warehouse. So the fair market value is important to both the seller and the buyer, because the fair market value is going to set the gain or loss for the underlying property, and it's also going to set the depreciable amount for the buyer. So for example, in this particular instance that we just walked through, obviously the buyer would vastly prefer to associate value, right, amount realized fair market value with the warehouse, because irrespective of what the seller's gain might be, the warehouse is depreciable and the land is not. So it would be in the best interest of the buyer to say, oh, well, the value of the land's really low, but the value of the warehouse is really high. And that might be the exact opposite for the seller. Now, in this case, it's probably not the exact opposite, but it could be that they'd like to spend less on the warehouse because it's been depreciated, right? And so that might lower the gain on the warehouse amount, and therefore reduce the 1245 recapture, in this case the 291 recapture, because we're assuming they're corporations. So there's some friction between the two, and so as a result, generally speaking, whatever allocation in the sale agreement has been reached between the buyer and the seller will generally be respected by the IRS, unless there's a sense that the purpose behind the allocation was tax avoidance. So A is the sole shareholder in Target Corporation, has a $100,000 basis in her T stock. T's only asset is land with a fair market value of $400,000 and a zero adjusted basis. And Buyer Corp, which is B, sometimes they use B, sometimes they use P. In this case, I guess I'm using B, wishes to acquire the land for $400,000 cash. So let's think of three ways in which this could happen. So the first is A could liquidate T. Right? So T would distribute the land to A in a complete liquidation, and then A could sell the land to B. T would recognize gain, and A recognizes gain on the deemed sale of the stock, right? So again, there's not really a deemed sale. A just recognizes gain because there's a complete liquidation of the underlying corporation. So the other way is, of course, T could just sell the land directly to B. So the sale of T assets, and then, since that's T's only asset, it then liquidates, right? So T sells the land to B for $400,000. Then it liquidates, distributing the after-tax proceeds to A, right? Because there's no reason for T to continue to exist. And so once it winds up its stuff, it just distributes the after-tax money that it has left to A, the shareholder. And then the last one would be a sale of T stock, right? So A just sells her shares in T to B for the $400,000. And then B liquidates T and distributes the land to B. So, that's kind of what we're looking at in terms of the three choices we have, which is really what we're trying to do is get that land in the hands of B. And since it's T's only asset, we're looking to wind up T as a result. Okay, so let's look at the outcomes. So the liquidation of T followed by the shareholder sale of assets, right? So this is the long way. So T distributes land to A in a complete liquidation, and then A sells the land to B. T recognizes gain, A recognizes gain on the deemed sale of stock. So T recognizes a $400,000 gain, because recall that T's basis is zero, the market value is 400. So in that distribution of the property, it's deemed to be sold at its fair market value by the corporation. So A must bear the burden of T's taxes because T's got nothing left. So, and since A wholly owns T, it's really irrelevant who bears the burden. So thus A has a gain of 216,000, right? That's the 400,000 minus their $100,000 basis in the stock, minus the 84,000 of taxes that they have to pay on behalf of T. So A takes a $400,000 basis in the land and then sells it to B for no gain or loss. So A is left with 283,600. That's the 400,000 of proceeds they receive, minus 84,000 of corporate tax paid by T on the liquidation gain, and then minus the 32,400, which is the gain on the sale of the land to B. Sorry, not the sale of the land to B, the sale of their stock in the complete liquidation. My bad. Okay, so on to number 2. Sale of T assets followed by liquidation. So now T sells the land to B directly for the 400,000, and then once it's done, it liquidates, distributing after-tax proceeds. So let's think about what happens. T recognizes a $400,000 gain and pays corporate tax of 84,000, leaving 316,000 to distribute to A in a complete liquidation. A recognizes a $216,000 gain, right? Because that's the 316 over their basis in the stock, and pays 32,400 in cap gains tax, and B takes a $400,000 basis in the land. So you can see that the outcomes from those two are identical. Both of those are the same. And that's exactly what the complete liquidation rules are designed to do. It shouldn't matter whether it's liquidated first and then sold, or sold then liquidated. The outcomes should be the same, shouldn't they? Yeah, there's no reason for them to be different. Okay, so the third option, as you recall, was the sale of T stock, where A sells her shares to T, in T to B for 400,000, then B liquidates T and distributes the land up to B. And we're going to defer that conversation. Now we're going to get to it, but we're going to defer. All right, so when we do these assets sold as a bundle of different assets, and it includes intangibles, history has revealed a proclivity on the part of taxpayers to assign fair market value away from long-lived intangibles. So now recall that under bonus depreciation, anything eligible becomes target number 1, right? So this means that, wow, I really want to assign things that I can take bonus depreciation on, because that means I recover those costs immediately. So in any event, Congress had to issue guidance on exactly how the allocation of assets, the allocation of purchase price would take place into assets. And it should come as no surprise, it kind of matches what we do in purchase accounting for book purposes. So the consideration received for assets shall be allocated among assets acquired in such acquisition in the same manner as amounts are allocated to assets under 338b5. In connection with an applicable asset acquisition, the transferee and the transferor agree in writing as to the allocation of any consideration, or as to the fair market value of the assets. Such agreement shall be binding on both the transferee and the transferor, unless IRS basically determines that it's not appropriate, meaning there's some sort of tax avoidance scheme. So we already know this, right? We're going to allow what the purchase and sale agreement says to stand, barring any sort of interpretation that it might be for tax avoidance. So for purposes of this section, applicable asset acquisition means any transfer, whether directly or indirectly, of assets which constitute a trade or business, and with respect to which the transferee's basis in such assets is determined wholly by reference to the consideration paid for such assets. So 1060 only applies when you're determining the basis of those assets with respect to what you pay for them. So a stock acquisition would not apply. That's why basis just carries over. All right, so we use the residual method, and the way that works is you allocate based on a sequential and hierarchical basis. And so you can see that you allocate these first to class 1, class 2, class 3, class 4, class 5, class 6, and class 7. And you do it so you say, all right, well, cash is the most objective of all measures because basis and market value are generally the same. So cash gets allocated to cash on its market value. Then you'd look at what I would describe as cash equivalents, right? So certificates of deposits, marketable securities. Then accounts receivable, because they're as close to cash as you can get. Then inventory. Then tangible real property and personal property. And then any section 197 intangibles, because remember, this is the acquisition of a business. So customer list, trademarks, franchises, covenants not to compete, and then goodwill, right? Goodwill is the catch-all, of course, that gets anything else. So the reason that Section 197 tangibles, and we've discussed this before when we talk about 197 intangibles, is they're all amortized over 15 years. So before 197, you used to amortize each of the intangibles over its remaining useful life. So you'd say, oh, customer list, 2 years, know-how, 5 years, patents remaining useful life, goodwill, however long. Well, 197 said, look, what everyone's going to do is associate more value to the customer list than probably deserves to be valued to that. So we're just going to make everything a 197 intangible that you amortize over 15 years. So now it doesn't matter what you allocate to the customer list versus goodwill. It's all going to be amortized over 15 years. All right, so the total proceeds to be allocated can be made more complex through things like indemnification escrows. So this is, hey, you're telling us you don't have any hidden liabilities, but maybe you do. Maybe, this land that we purchased, it turns out you've polluted the groundwater underneath. And so there's going to be some indemnification money held in escrow pending some contingent outcome. It could just be a contingent purchase price. So it's based on EBITDA that's going to be generated from the business after the fact. And what happens is these can leave an open or a closed transaction. So deferred payments are treated as made in an open transaction only in rare and extraordinary circumstances. So this would mean the payments are so contingent and so speculative that the value of that future value can just simply not be reasonably ascertained. So basically, open transactions are rare. All right. So let's talk about an asset sale by the corporation without a liquidation afterward. So the proceeds could be held in corporate form and the corporate structure simply maintained. And really what would happen is there's a deferral opportunity as the shareholder level gains, and of course the tax that's with them would be avoided. So this suffers the lock-in effect because retention of the stock until death would enable a 1014 basis step up. That shouldn't be a setup, it should be a step up in basis, right? So think of it as, hey, if the assets are sold by the corporation and we don't liquidate the corporation afterward, then what happens is that second step of the gain, let's go back so that we know what we're talking about. That second step of the gain where the company's liquidated, right, never happens. If that never happens, then of course that second gain never occurs because there's not a complete liquidation. And so that would mean like, hey, that gain's just stuck in limbo in the corporate form until we liquidate. Well, we're never going to liquidate. Instead, you're going to wait until I die, and then you're going to get a step up in basis on the stock, and we'll avoid the tax forever. So obviously, there's some personal holding company risk status. There's some personal holding company risk because you might be held to be a personal holding company. You could possibly try a conversion of the corporation to S status, but there's provision that limits that from having been done. Okay, so basically that's a loophole that you can't really drive your truck through. So the seller in most of these situations will want to sell to target the stock, not the assets, right? For some of the non-tax reasons we talked about. But even from a tax perspective, what happens is, because if the target corporation sells assets, then it's going to want to allocate proceeds to those capital assets producing long-term capital gain. For individuals, there's a tax rate differential for long-term capital gains. But remember, for corporate sellers, there's no tax rate differential. Now, they might want the gains to offset some capital losses that they have. So that would be a reason where the target corporation may want to sell the assets, but generally they don't, right? Instead, they'd rather just sell the stock because then there's only a single layer of tax that occurs. It's just on the sale of the shares. Whereas the buyer, of course, they want to purchase the assets. They want the assets so that they can take the market value as basis because that's what they paid for it. So if they just buy the stock, they don't get that basis. And we're going to talk about when, this liquidation occurs of the corporate subsidiary. Remember, their basis in that stock just evaporates, it disappears. So the buyer will want to allocate the purchase price to inventory and other short-lived assets, or of course, anything they can take bonus depreciation on, because that gives them an immediate tax deduction of those costs. Okay, so here we are back to our key example again. A's the sole shareholder in Target, has $100,000 stock basis in her T stock. The only asset is the land with $400,000 fair market value, zero basis, and B wants to buy that land. And they're prepared to pay $400,000 in cash. So one of the examples we've already discussed, and we're going to walk through it again, is the sale of T assets followed by the liquidation, right? So T sells land to B for $400,000, then liquidates, distributing after-tax proceeds to A. And we know the outcome from that is that T recognizes the $400,000 gain on the sale of land. They'll pay corporate tax on the gain of 21%. The remaining $316,000 gets distributed to A in a complete liquidation of T. A then recognizes the $216,000 gain, pays the 32 foreign cap gains. B gets the land exactly how they want. So this outcome is the one that B really likes, but A may not like it so much because, of course, they're paying 2 layers of tax. So this is what happens with the sale of T stock. So now A sells her shares in T to B for $400,000. B liquidates T and distributes the land to B. So A has a recognized gain of $300,000, right? Because now the $400,000 is the total proceeds for the sale of shares. And A's the only one that recognizes gain of $45,000 because cap gains tax 15%. B takes cost basis in T shares. So the basis that B has in T shares is $400,000. But remember what happens when you liquidate a corporate subsidiary. There's no gain or loss and basis carries over. So what happens is B then liquidates T. T's basis in its assets just becomes B's basis. So they step into those shoes along with all the under tax attributes. So A's happy because they got cap gain treatment for everything, only a single gain, and of course wanted no corporate level tax to pass through to her, and that's been avoided. But B is unhappy because now they've paid $400,000 from assets, but will not recover any of their costs unless they're able to sell the shares of T, right? Because if they liquidate T, then 332 applies and boom, it's all gone. That basis evaporates. So they never get a step up in basis for those assets. So this is a bad outcome for B. Okay, so we have a situation where there's a difference in treatment between an asset acquisition and a stock acquisition. And this is seemingly for no good reason. It's simply the way the law is written. So way back when, there was this concept called the Kimball-Diamond concept. And it permitted stock acquisitions to be treated as asset acquisitions, but it was applied extremely inconsistently, and it was based on taxpayer intent, and so it didn't really work out. So then finally Congress said, okay, we need to fix this. We're going to throw away Kimball-Diamond, and instead we're going to create Code Section 338. And so an election under 338 could give us the outcome we're looking for, but it's only going to be advantageous if the target corporation, has either net operating losses or other built-in losses to offset gains on what's going to be a deemed sale of the appreciated assets, or if there's some other reason to try to cleanse the target's tax history. Now, another fix is 338H10. We'll talk about that one. And the most recent fix is 336. Okay, so let's talk about these tax consequences for a second. All right, so when we get to use 338, so Parent Corp P has basis in target subsidiary T's assets that equals the basis in the subsidiary stock. So this is the outcome we're looking for, right? We want that step up in basis. Now, T may but need not be liquidating. T is deemed to have sold its assets for an amount determined with reference to P's basis in T's stock, adjusted for the liabilities of T. So gain or loss would be recognized by T as if it sold its assets for fair market value in the deemed sale. The subsidiary is treated as a new corporation that purchased all of its assets on the day after the qualified stock purchase date. Notice that the tax attributes do not carry over. So this is basically what 338 basically says is, yeah, we get it. You're acquiring stock, but we're going to let you treat it as if there was a deemed sale by the target subsidiary for the fair market value, which is that's the in reference to what P's basis is, right? That's basically saying in reference to the amount you paid for the shares of stock. So what are the requirements? Well, acquisition by purchase by a corporation of at least an 80% interest in another corporation during a 12-month acquisition period has occurred. The purchasing corporation acting alone, so this is only on P, makes the 338 election. Once made, it's irrevocable. Must be made by the 15th day of the 9th month after the month of the acquisition. It is treated as a hypothetical sale of the assets at their fair market values as of the acquisition date. And the purchasing corporation has the income tax payment obligation for the gain. So P is tagged with the tax on the deemed sale. The corporate tax liability on the deemed sale from old target to new target stays with the target, which the stock purchaser has acquired. So think of this as, well, I tell you what, don't think of it as anything. We're just going to keep going through examples. I'm going to beat you to death with examples. I apologize, Erica. So T's tax liability for the deemed sale is deemed to occur after acquisition. Again, as a reminder, that means P, the purchaser, bears the cost of T's tax. Recall that in the previous versions, the sale of assets or the liquidation of the corporation and then the sale of assets, it was A that bore the cost. So the seller was bearing the cost. But in a 338, the purchaser is going to bear the cost. So this is going to create some problems, right? 338 is not the panacea that everyone would necessarily be looking for. So let me show you why it's not the panacea through some examples. Let's recall the simple asset purchase. All right, A owns 100% of the stock, basis 200 of X, which owns one asset, a rented machine with a value of 1,000 and a basis of 200. X has no goodwill. Assume the applicable tax rate on all taxpayers is 25%. And that's just so that tax rate differentials don't weigh into this analysis because tax rate differentials just complicate it. So if X sells the machine to Corporation B for $1,000 and liquidates, let's think about what happens. So this is a simple asset sale. X would recognize a gain of 800, right? That's the fair market value. That's what's paid for the machine, 1,000 minus the basis, 200. And it would end up paying $200 in tax because, again, we're assuming a 25% rate. B will take a $1,000 basis in the machine, so they get the step up that they're looking for. A then gets $800 in the liquidating distribution, right? Because X has $1,000, but they got to pay $200 in tax. So they're left with 800. That 800 is distributed out to A in a complete liquidation. A will recognize a gain of 600 and will pay tax of 150. They'll net 650. So jointly, A and X together will have paid $350 in tax. Let's look at the stock purchase, version 1. Okay, so now instead, A's convinced, is A the, yeah, it's A. A's convinced B, no, don't buy the asset. I want to sell you the stock. So B says, all right, looks like the stock has a fair market value of $1,000. Now that's a mistaken assumption. So, but B buys X stock for 1,000 and then is going to liquidate X under 332 because recall that this is now the corporation, right? B is a corporation and it's going to liquidate X into itself. That's the liquidation of a corporate subsidiary. So A recognizes gain of 800 on the sale of stock and pays tax of 200. Great. A's really satisfied here. right? Because they've got the gain only on the sale of their stock, then they only have to pay tax on that one item. X has no gain or loss recognized. B will hold the machine at a basis of 200, right? So this is where B's getting hammered, right? Because if then B sells the machine for 1,000, because that's what it's worth, it will pay $200 tax and net 800. Thus, B will have lost $200 economically because it paid too much for the stock, because it failed to account for the built-in tax liability, right? Which can be viewed as the potential tax on the disposition of the machine. So think of it as, look, what happened is B paid $1,000 for the stock. And it said, well, that's because the machine underlying is worth $1,000. But at some point, that machine has to be sold or depreciated or whatever it might be. And as a result, there's going to be some tax on that item. And B didn't account for that tax. And so as a result, they overpaid. Okay, so B will not have a tax loss to accompany its economic loss. Because remember, its $1,000 basis in the X stock will disappear when it liquidates X into B. So A and X are better off, but B is not happy. Okay, so B says, this deal's not going to work for me, right? We don't have what we're looking for. We've got a straight up stock acquisition. This is the problem with the stock acquisition. So let's go to version 2 and make that 338 election. Okay, so B buys the X stock for 1,000, makes the 338 election. So now A recognizes $800 gain, pays $200 in tax. Again, A is loving it because they only have that one layer of tax they have to pay, and they're out of the system and they sold their stock. X will be deemed to sell the machine for its value of $1,000. X will pay $200 in tax. If X is then liquidated, B will receive the net value of $800, but again, they will have lost $200 because remember, the purchaser pays the tax in a 338 elected acquisition. So even though they got the step up, right? Okay, awesome. We got the step up in basis to the machine for $800, but we got to pay the tax on the gain as opposed to the asset sale. Remember, in the asset sale, the seller pays the tax. So B will hold the machine with a $1,000 basis. Now, eventually, they will save the $200 back because now they get to amortize or depreciate that machine. Now, the good news is with bonus depreciation, that actually works. There's no difference, right? Because B would immediately deduct the value of that machine. As a result, they have a $1,000 deduction. Remember, a 25% assumed tax rate means that they're actually going to save the money, right? They're going to save that same amount. And as a result, they'd offset that gain. Generally, and since we're down to 80% bonus, the problem is the discounted present value of that tax savings over the depreciable life of the machine is less than the $200 of tax you got to pay today. In other words, it's not really worth it to pay tax today in hopes of saving tax in the future. Moreover, B literally will be charged with a separate asset of goodwill under the regulations because the residual allocation rule having a basis of 200. Since there's actually no goodwill, however, it's be unclear if ever B could write off that excess basis amount. Probably 15 years, but we're not even sure of that. All right, we already talked about the bonus depreciation, saving it. Okay, so now B's getting smart. They're learning. And we got to move to stock purchase version 3. So now based on what we know, of course, B's only going to want to pay $800 for the stock because it's going to be like, wait, I'm getting screwed out of $200 in tax here. So instead, I'm going to buy the stock and I'm going to make a 338G election because I don't need to anymore. So A would recognize a gain of only $600, but it of course only receives $800, right? So it's paying an implicit tax of $200. B gets only a $200 basis in the machine. So A will net only $650 after A's own tax of $150, the exact same as if they had sold the machine for $1,000, paid the $200 tax, and liquidated. So now neither B nor A are happy. So they're not liking this outcome either because B has only an $800 basis in the asset. And of course, A should have just sold the asset and liquidated, and they would have been better off. All right. So now we need to say, all right, let's combine everything. Let's let B pay the $800 for the stock and make the 338 election. Okay, so now X is deemed to sell the machine to itself for $1,000, right? Because there's a deemed sale. The $200 built-in gains tax is a liability of X that increases the $800 stock purchase price to $1,000. Because remember, we established the deemed sales price with reference to the market value of the assets plus liabilities. Okay, so what happens is the deemed sales price, even though the actual sales price is only $800, is up to $1,000. And of course, X will pay the $200 in tax because they're required to do so. A recognizes a gain of $600 and pays $850 in tax. Well, A doesn't have a problem with that, right? So they end up with $800 in their pocket. They're okay with that. They're okay with paying $150 tax. B takes the $1,000 basis on the machine. So the $350 in tax will have been paid, same as if X had sold its assets to B in the first place. There we are, right? We've got the parity we're looking for. So this is what happens in a 338 election, right? The idea is we're trying to get to parity between an asset sale and a stock sale. So we know that 338 has achieved some parity. The choices facing the potential corporate or non-corporate acquirer of most or all of the stock of the target corporation having substantially appreciated assets are stark. So you either pay full value for the assets and obtain cost basis that will yield commensurate tax benefits in the future, or try to buy the stock at a price discounted from the inside asset value to reflect the potential corporate tax on the built-in gain. And so there's actually a lot. Notice that we just assumed the 800, right? Well, A wants $1,000 still, right? They're like, hey, it's not my tax. That's not my problem. The machine's worth $1,000. And so, what happens is there becomes a negotiation between A and B. And, you want to try to establish, if you're B, of course, you want to try to share some of that tax cost. And if you're A, you don't want to pay any of that tax cost. And there's there was a really great court case involving DuPont that really provided a lot of the insight into how this negotiation works. But I'm not going to make you read it. Okay, so the seller result is a tax on the gain on the sale of stock. The seller is not responsible for the tax on the hypothetical sale. The buyer gets the stepped up basis in the assets, but it does have to pay the tax on the hypothetical sale. The tax attributes end through liquidation, and the target emerges as a new corporation, probably going to be liquidated, but not necessarily, right? Because it only had that one asset. So there's no real reason to keep it in its separate corporate form. You can now liquidate it up, and there's no real loss of value because the buyer gets the stepped up basis. Okay, so let's talk about this hypothetical sale of assets. And we said that what happens is we establish this grossed up sales price. Well, how do we do that? We do that under something called the aggregate deemed sales price. This is the price that we use to allocate the price allocable to the assets that are deemed sold by the target. So the target's treated as selling assets for the ADSP. If all of the T stock is purchased at once, it's super easy because it's basically just the grossed up amount for tax liabilities. If it's not, then it gets more complicated. And I'm not going to hold you responsible for the more complicated, but I do want you to know that it exists. So let's say that the grossed up amount realized on the sale of T's stock to P on recently purchased shares. So P purchased 80% of T stock for $800,000 in the last 12 months. Well, then the grossed up amount would be $800,000 divided by 80%, or $1 million, plus the liabilities of old T, including tax liabilities from the deemed sale, right? So in this case, maybe P purchased 20% of T stock a long time ago at a completely different price. Well, remember, the price is set with reference to what was paid for the stock. So basically, they're like, wait a second, it's not fair for me to allocate the purchase price of something that I paid for a long time ago. We need to gross that up. That's why it's an aggregate deemed sales price. And again, that's a complex. When you buy it all at the time of the acquisition, it's easier. It's when you have a longer window on the purchase that you got to get involved in this grossing up. Okay, so remember that new T's basis, because it's kind of right, it's like liquidating T into itself. Everything's sold at its market value. Well, I should say at the adjusted gross up, or sorry, at the ADSP. So we need to determine what is T's basis in the assets. And you'd think it's the fair market value, but it's not necessarily. It's AGUB, or the adjusted grossed up basis. So the grossed up basis is P's recently purchased stock, again, grossed up for the shares not owned, plus P's basis in non-recently purchased T stock, plus the liabilities of new T, including, again, the tax that's going to be triggered on this deemed gain. So the objective of determining the tax basis is to determine the amount to be allocated to the various assets after the deemed asset purchase. So, and you use the same rules that we used under 1060 to allocate the purchase price. So if all the stocks purchased in the 12-month period and there are no contingent liabilities, so it's a fairly simple acquisition, then ADSP will equal AGUB or AGUB, right? They'll be the same because we didn't purchase shares that are old that have a completely different basis. All right, so P acquires all of T's stock for $3 million and elects 338. The AGUB of T's assets is $2.4 million. What happens to the excess of the AGUB over the fair market value of the assets? Well, that's just simply going to be allocated to goodwill, right? That's the final version. So once you're done allocating AGUB to all the different assets, to the extent it's more than the market value of the assets, which of course it very well could be, then you end up with goodwill that gets amortized over 15 years. Okay, so we're getting close, but we're not quite there. So recall that the buyer gets tagged with the tax in a 338G. So this is a hypothetical sale of the assets that's deemed to occur on the purchaser or the buyer's watch. So parent P owns target T and has a greater stock basis than T's basis in the assets. So think about this for a second. I'm not suggesting this is the outcome that we would often get. So P owns target T and has a greater stock basis than T's basis in its own assets. But the fair market value of T's assets also exceeds the basis, which that is a likely outcome. So B wishes to purchase T's assets, and of course they want the step up in basis. So P liquidates T into P. No gain or loss recognized for P or T, right? Because we got a parent that is liquidating a corporate subsidiary. P then sells T's old assets directly to B. So P recognizes gain on sale of assets, but does not recognize gain on the sale of stock, because remember, 332, B gets a stepped up basis. This would not work in a stock deal, but maybe it should, right? Maybe it should. Maybe there's no reason that a deal like this couldn't be handled somewhere else, right? When we're not doing an asset sale, instead we're doing a stock sale. This is the acquisition of the stock of a corporate subsidiary. So a parent corporation is the seller of the target subsidiary corporation's stock, thus keeping the sub alive. So the deemed sale happens on the parent's watch. Notice, this is on the seller's side, not the buyer's side. So unlike a 338G election, a 338H10 election treats the transaction as if it were a sale of T's assets while T remains a member of the parent's consolidated group. And then old target then liquidates tax-free into parent under 332. So let's make sure we understand that, right? So basically what we're saying is this situation where P liquidates T into P, right? So B wants T's assets, wants the step up in basis. Of course it does. P liquidates T into P first. Then P sells T's old assets directly to B. So P recognized the gain on the sale of assets, but not the stock because of 332. Well, what we're trying to do is, rather than liquidate T, we're trying to sell T over to B, right? So we're trying to do another stock sale. Well, this is where 338H10 can come into play. So T is 100% subsidiary of P, the seller. B wishes to acquire T. T's stock is valued at $400,000, as are T's assets. P's basis in T shares is $100,000. T's basis in his own assets is $100,000. Now, B and P are required to make a joint 338H10 election, right? So that means the buyer and the seller both have to be in on this. So what happens is old T sells assets to new T, and then new T distributes the assets to P and liquidates. P does not recognize gain or loss on the sale of its T stock. B inherits all of T's tax attributes, and T is treated as having sold assets at the fair market value and gain or loss, and all that's included on P's consolidated return. Again, the seller pays the tax. B takes T's assets all at the adjusted grossed up basis. So this is generally advisable because it avoids double taxation while providing a step up in inside asset basis to P. With this said, it is extremely beneficial in the following two further factual variations. If the seller has a potential gain on the stock, so they have a low outside stock basis, but the inside asset basis is higher, so that the gain is smaller from the asset sale, well, then 338H10 makes perfect sense. And this is often the case, right? So, if the seller created the corporation a long time ago, it probably had a low basis in the stock of the corporation. But now that subsidiary has been operating successfully for some time. And so that inside asset basis is going up, up, up. But of course, their outside basis isn't moving at all. So they might be into 338H10 sounds pretty good because as a result, we get to measure against the higher basis of our stock as opposed to, the assets as opposed to just what we have in our stock basis. The seller's consolidated group might have losses from other operations. Another good reason to trigger a 338H10. It's like, hey, we sold this other thing at a giant loss. Oh my God, we're a corporation. That means we got 3 years, right, to try to offset these capital losses. Man, we better go find some capital gains. So let's sell a sub and do a 338H10. And again, it's a joint election between the buyer and the seller. All right, so the last one is 336. This allows a parent to treat the disposition of subsidiary stock as a deemed asset disposal, similar to treatment of 338H10, but it's broader, right? It applies to any disposition of subsidiary stock, including dispositions to individuals. 338 applies only to purchases of stock by a corporation. It can also apply to disposition of stock, including liquidations. 338 only applies to stock purchases. So 336 permits the seller only to make the election, whereas 338H10 requires both. What happens is when you go to a potential buyer and you go, hey, I want to do a 338H10, then they know you've got skin in the game. And it means, oh, so I can lower the price then, right? It gives them a negotiating chip. And one might argue that's not really fair, right? Because now I'm exchanging this tax that you or I are going to need to pay through the purchase price. That's where 336 might have a slight advantage because you don't have to notify the buyer. Purchasers who acquire stock should be aware of a 336 and contract for what they want, right? So purchasers might want to forbid the seller from making a 336 election. Then again, they might want them to make the election to get the asset basis step up. So Either way, this choice becomes part of the negotiation of the sale of the subsidiary, or its assets, right? Because you might just be willing to get rid of the assets, but the buyer might want the stock, or you might want to sell the stock instead. All right, believe it or not, 50 minutes in, that finally brings us to the end.